Has the stock market rally started to show signs of fatigue? That's the question on many minds as we delve into the recent happenings in the financial sphere. Just recently, the stock market rally, which had been on a steady uphill climb, took a slight step back. Our financial giants, the Dow Jones, S&P 500 and Nasdaq, all experienced slight losses. The Dow Jones, a beacon of the industrial sector, faltered. The S&P 500, a reflection of the larger market, experienced a similar dip. And the tech-heavy Nasdaq was not immune either. This retreat, albeit small, serves as a reminder that even the seemingly invincible market rally is not immune to losses. Furthermore, the 10-year Treasury yield, often viewed as a barometer of investor sentiment, also took a slight hit, falling to 4.37%. This subtle shift might not seem significant, but in the grand scheme of the financial world, it's a movement that can't be overlooked. Adding to this shaky picture, crude oil prices, a critical component of the global economy, tumbled nearly 4%. This drop in crude oil prices has ripple effects, influencing various sectors from transportation to manufacturing, and even impacting the pockets of everyday consumers. In the geopolitical arena, we witnessed a ceasefire in Gaza between Israel and Hamas. This 4-day halt in hostility, while a positive step towards peace, adds another layer of complexity to the global market landscape. While the market rally remains strong, the recent dip has raised eyebrows among investors. It's a stark reminder that the financial world is a complex tapestry, interwoven with various threads from different sectors and regions. As we move forward, it's crucial to keep a close eye on these developments, as they may be indicative of broader trends in the shaky market. Nvidia, a tech giant, is making waves in the AI industry. With a focus on the heart of this revolution, let's start with Nvidia's financials. The company, responsible for a significant portion of technology in use today, recently delivered a jaw-dropping 593% increase in earnings, a growth rate that would pique the interest of any investor. Their revenue also enjoyed a notable skyrocketing by 206%. This financial surge is a testament to Nvidia's relentless innovation and their stronghold in the AI chip market. Their GPUs, the driving force behind everything from AI chatbots to advanced gaming systems, have seen a surge in demand, thrusting them to the pinnacle. While Nvidia basks in the limelight, other tech behemoths like Microsoft are not far behind. Companies such as Microsoft, AMD, Alphabet, Meta Platforms, Palantir Technologies and Supermicrocomputer are also crafting their own space within the AI industry, contributing to the sector's overall growth and innovation. One noteworthy development in this area is the recent return of Sam Altman as CEO of OpenAI, a company with Microsoft's backing. This move marked the end of a 5-day saga and has rekindled interest in the company's AI endeavors. Now, with Nvidia's impressive earnings, one would expect their stocks to be soaring. However, here's where the plot thickens. Despite posting strong numbers, Nvidia's stock took an unexpected plunge post the earnings announcement, leaving investors puzzled as to why such a financially robust company would experience a decline in stock prices. Despite earnings, Nvidia's stock initially dropped, a move that left investors. While some companies bask in the glory of strong earnings, others report mixed results. Let's take a closer look at some of these contrasting scenarios. Urban Outfitters, HP Inc., Autodesk and dLocal have all recently reported earnings, with outcomes that could be best described as a mixed bag. From fashion to technology, these companies reflect the broad spectrum of sectors in the market, underlining how diverse the current financial climate truly is. Urban Outfitters, a well-known name in the retail industry, along with technology companies HP and Autodesk, and financial service provider dLocal, have all painted a rather varied picture. While some have managed to exceed expectations, others have struggled to meet them, reflecting the unpredictable nature of the market. A similar trend can be observed in the performance of various sector-specific ETFs. ETFs, or exchange-traded funds, are marketable securities that track an index, a commodity, bonds, or a basket of assets. They have been known to provide a degree of stability in turbulent market conditions. However, even these have not been immune to the unpredictability of the current market. Growth ETFs like the iShares Expanded Tech Software Sector ETF and the VanEck Vectors Semiconductor ETF have seen slight declines. These ETFs are typically seen as barometers for their respective sectors, indicating a cautious sentiment in the technology sector. Furthermore, Larger declines have been experienced by the likes of RK Innovation ETF and RK Genomics ETF. These ETFs are known for their focus on disruptive innovation and genomics, respectively. Their decline could be indicative of investors' wavering confidence in the future of these cutting-edge sectors. In summary, the market trends paint a picture of mixed results and cautious optimism. While some sectors and companies continue to thrive, others are experiencing a slowdown. The market continues to show mixed signals, leaving investors in a state of cautious optimism. As we look forward, the actions of the Federal Reserve remain a point of interest. The era of the Federal Reserve enabling big budget deficits by keeping interest rates low is nearing its twilight. The repercussions of these policies are becoming increasingly clear, with the long-term costs starting to surface. As the market adjusts to this shift, it's crucial for investors to understand the implications. Low interest rates have, for a long time, fueled market growth, allowing companies to borrow cheaply and consumers to spend more freely. It's been a recipe for economic expansion. However, as the Federal Reserve signals a change in course, we're likely to see a shift in the market's trajectory. Higher interest rates could lead to a tightening of credit, potentially slowing economic growth. In these changing conditions, the direction of the market should be monitored closely. The market rally has shown resilience, but as we've seen, it's not immune to retreats. It's important to remember that while market rallies can be a boon for investors, they can also lead to overextension. That's where sell rules come into play. Investors should be significantly invested to take advantage of market growth, but adhering to sell rules is equally important. These rules help investors protect their gains and limit their losses. In a market that's constantly evolving, having a strategy to manage risk is crucial. Whether it's setting a stop-loss order to sell a stock when it reaches a certain price, or diversifying your portfolio to spread risk, there are several strategies that can help you navigate the market turbulence. As we traverse this shifting landscape, it's essential to remember that while the market's direction can be influenced by a myriad of factors, staying informed and vigilant is key. Market trends, corporate earnings, geopolitical events, and economic indicators are just a few of the elements that can impact the market's direction. With changing market dynamics, constant vigilance remains the watchword for investors. As the Federal Reserve shifts its stance and the market adjusts, staying attuned to these changes will be paramount. After all, in the world of investing, knowledge is not just power, it's profit.